What are mortgage rates doing in 2025? Well, let's ask an expert. I'm here with Rhonda Hummel. We're going to dive into what mortgage rates are doing and then ask her a few other questions. But before we do that, Rhonda, can you give our audience a little bit of a background to who you are?
Sure. I've been in the mortgage industry for now, this is my 32nd year, and I'm not even that old, Jared. And I've seen, the lows of the twos and the highs of the eights and refinance people out of, 10.5 mortgages, 10.5%. And you're a hero, and then, rates go up very quickly like they did in 22. Yep. And people are like, these rates are insanely high. Well, if you look at a 50-year historical of mortgage rates, we're in the bottom 20% of all-time low. So rates are still great, and, it's just hard for people to think of going out of their mortgage at 3% versus at 7% or 6 3/4.
And I actually just closed a deal on a property. Rhonda was excellent with my buyers, getting them pre-approved and essentially getting them to the closing line. And essentially with that being said, she's there to be able to answer questions. And the one thing that I am learning is that there's really not that much of a difference between 6 and 7%, especially when you look at the year-over-year return of investment. So we're gonna dive into all of that. But before we do, make sure to hit that like button, subscribe to this channel. I'm putting out as much content as I possibly can for buyers, sellers, landlords, and tenants regarding everything real estate. Well, let's go ahead and dive into the video. All right, Rhonda, what are current jumbo mortgage interest rates today?
Well, for Orange County, and it's based on loan amounts, so every year Fannie Mae comes out with loan limits, conforming, jumbo, and high balance. We happen to be in a high-cost zip code or county, and so our conforming loan limits go all the way up to over $1,209,000. And the rates today are about 6 3/4 for a 30-year jumbo fixed, and that's at 0 points.
Okay. And you mentioned earlier that 6% to 7% were essentially at an all-time low when we look at historic rates, if I'm not mistaken.
Bottom 20%, yes.
Well, essentially, one of the things that I want to also dive into is what we could expect looking into further into the year. So, Rhonda, what could we expect with mortgage interest rates going into further into the year?
Yeah. That's a great question. I mean, all of us wish we had a crystal ball, right? But a lot of factors go into mortgage rates, and it's not prime rate, it's not anything. It has to do with the 10-year bond. So as the bond market goes down, interest rates will follow. However, we can listen to all the different, economic indicators, and the prediction is low 6s, high 5s by the end of 2025. Okay. I hope that's true, because I think that will, bridge the gap between a 3% and a 7%, at least 50%, a little over 50%.
And one of the things that I want to do is kind of put that into example. So essentially, if someone is buying $1 million property, and let's say they're going to be putting 20% down, which means they're going to be financing about $800,000 of that. At 6% to 7%, what is the actual difference of those two mortgage rates?
So let's do it on an annualized basis, only because, you're buying an investment, right? And it's not an investment as an investment property, but you're investing in real estate, which is how people build their wealth. And a 7% rate, the payment is X. But all in all, it's $6,307 more in that first year that you would have paid at 7% versus 6%. So I always pose the question to buyers that are, well, I'm going to wait for rates to come down. Well, guess what? Average appreciation, and we do it by city, but I'm just going to take it for the county, is 8%. So if you purchased a property for $1 million and your property value in 1 year went up 8%, what is that number? $80,000, right? So I always pose the question, would you invest $6,300 or $6,307 to make $80,000, right?
Yeah.
So that's how I put it. And always, never once did anybody ever answer me and say no. So that's how people build their wealth. And, some years it's going to be 5%, maybe no appreciation 1 year. But over historical person averagely owning a property of 7 years, I believe.
Yeah.
They would have built that wealth within that property, and that's how people buy up and accumulate a down payment for a higher property.
Especially in this appreciation market of Orange County and Southern California as a whole. Like the property that I mentioned earlier that we closed out, we're on. One of the key things that I love to do is actually run through the entire data with my buyers. So we look at things like InfoSparks, and we actually look at what comparables are doing, and looking at the year-over-year appreciation, especially in places like Irvine. I mean, they were getting a 13.2% return of investment for that property. So when we look at potentially waiting for mortgage rates to drop, it did not make sense when you look at 2, 3, 5 years out from now on where that house is going to be just off of appreciation. So that's why I like to actually put this into examples so people could actually see the difference of 6 to 7% and then compare it to the year-over-year appreciation.
And and back in, the early 2000s up to, 2022, there was people that were refinancing, and they're saving money over money each time they refinanced, and some of them refinanced several times.
Yeah.
And, that also builds more equity because you can pay more towards your principal if you choose to do so.
Which is always a good thing.
That's right.
Well, as always, make sure to hit the like button, subscribe to this channel for more real estate content. Rhonda, thank you so much for doing the interview and for being here. If you need anything mortgage related, call her. If you need anything real estate related, call me.